Hello, my name is Ray Franklin. I'm the Senior Commodity Analyst for Energy Professionals. Today's video is a summary of my October 30th energy update. 6 months ago, in our April 10th energy update, we warned that natural gas would likely be heading higher based on the fact that since 2000, rates have been above where it was on April 10th, 96% of the time. Therefore, it was not surprising that natural gas is now 68% higher than where it was on April the 10th. And most importantly, natural gas is above the 200-day moving average. And this moving average is very important in that long-term traders look at the 200-day moving average as the trend, long-term trend, and likely to be major support on any pullbacks to this moving average. After reading the April 10th energy update, as you can see in this chart, those who heeded our warning that rates were likely moving higher and secured a fixed rate nailed the lowest rates of the year. But with that being said, please don't despair that you have missed a major opportunity. From a long-term perspective, this cycle of higher natural gas prices is likely still in its early stages, with higher prices still ahead. Since 2000, when natural gas declined to where it is in 2023, the average price was always much higher longer term, which you can clearly see in this chart. In the 4 previous blocks of pricing, the average price was always much higher at least 36 months. The question is, why does this pattern always repeat itself? And from a long-term perspective, why is the present cycle of higher natural gas prices likely still in its early stages? The answer is found by understanding the supply-demand factors that influence the price of natural gas. First, as we pointed out in our July 5th energy update, natural gas has declined to near today's unsustainably low prices 4 times, and in each case, the average price was always higher for an extended period of time. Prices this low were unsustainable because they were below the cost of production, and natural gas exploration and production companies were no longer profitable near those low prices. Therefore, they were highly motivated to decrease production, leading to higher prices, so they could recoup lost revenue. In the last report, Baker Hughes announced gas rigs were 25% below where they were this time last year. And this indicates natural gas exploration and production companies are decreasing new production, thereby slowing the growth of our supplies, which will support higher prices long term. But we have another factor that will influence the price of natural gas. While new production is decreasing, the demand for America's liquefied natural gas is dramatically increasing. Europe's green energy policies have resulted in a shortfall of natural gas, and they need to increase importing liquefied natural gas to meet their energy needs. In the most recent short-term energy outlook, the Energy Information Administration estimates that the United States will export a record amount of liquefied natural gas in 2023, up 9.7% from 2022. And in 2024, the EIA projects that liquefied natural gas will continue increasing, and we will export a new record amount of liquefied natural gas, up an additional 13.2% in 2024. And while the previous factors influencing the supply-demand of natural gas are important, we have additional geopolitical concerns that could trigger higher energy prices throughout the world. The potential for the Israel-Palestine conflict to escalate into a regional war is increasing day by day. And if the conflict does escalate, energy prices would be profoundly affected. For example, the Strait of Hormuz is a natural waterway connecting the Persian Gulf and the Gulf of Oman, and it is the only passage from the oil-rich Gulf to the Indian Ocean for maritime traffic. The strait is among the world's most important oil choke points, with oil tankers carrying about 25% of the world's total consumption, and a disruption in free passage would likely result in skyrocketing crude oil prices. Also, in Europe, liquefied natural gas spot prices have increased by more than 40% since the Israel-Palestine war began on October 7th, and if the conflict escalates into a regional war, natural gas and crude oil will become precious commodities, leading to much higher prices for both. The bottom line is the empirical observation that since 2000, The 4 previous times natural gas declined towards today's unsustainably low prices, the final lows always occurred either in the spring or fall, and the average price was always much higher for at least 3 years, should have been enough evidence for anyone with an agreement expiring in the next 18 months to not delay hoping for lower prices and hopefully reserve power to be available when their present agreements expired. But for those who did not heed our warning over the last 6 months that prices were heading higher long term, hopefully today's report highlighting geopolitical tensions will help you understand why protecting yourself against the risk of much higher rates is more important than ever, especially for those who have agreements that will be expiring in the next 18 months. And until my next report, please take care.